Hello and welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady and principal owner of Everett Tax Solutions, where we help you win the tax game. I am excited to be back recording and sharing content with you. I've had to take some time off to recuperate and all of those things from a really, really tough year. I have released my tax relief. ETS tax relief is the tax problem solving arm of my business. So even though I was away, I was still doing some stuff. But yeah, it's been a tough year, but we're still here. But let me tell you, I picked a heck of a day to come back. This tax court case that I'm going to review with you all, it's got a lot of lessons in here, both for consumers and for tax professionals. Okay, so this is the case of Lakeisha Degourville. I've got the tax court case here in my hand because this, y'all, it's a lot in here and I just want to make sure I don't miss anything. Okay, so this case is Lakeisha Degourville v. the commissioner of the IRS, and she represented herself in this tax court case. So basically what they were trying to decide is if she was going to be due a civil fraud penalty. So let's talk about the background of this case. Ms. Degourville was a tax professional. She owned a hair salon and she co-owned a restaurant with her husband. Now it says here that she worked for a tax company from 2007 to 2009, and then she went out on her own between 2011 and 2016. Now, she and her husband, they were married since 1999 up through at least 2016. And this is important when it talks about some of the stuff that she did. But in this court case, they said the issues to be decided were whether certain proceeds remitted to the petitioner's bank account or taxable income, the petitioner's filing status, the petitioner's claim to earned income tax credit, and the deductions for business expenses on 2 Schedule C profit and loss, and imposition of civil fraud penalty. Okay, so that civil fraud penalty is $100,022. Now, they determined a tax deficiency of $139,249. So let's talk about the taxable income. So during this time, Lakeisha and her husband, it doesn't say his name. Oh, Kenneth Degourville, there it is. Lakeisha and her husband, Kenneth, they made several cash purchases. They between 2012 and 2013, they purchased a property for $23,000, one for $20,000, another one for an unspecified amount, and another one for $52,000. In 2013, Kenneth made a purchase of $42,000, and then in also in 2013, they made a cash purchase of a plot of land for $90,000 and then paid $366,436 via personal and cashier's check for the construction of a home. Also, between 2010 and 2013, they purchased a 2006 Hummer, a 2009 Chevy, a 2012 Lexus, a 2013 Honda, 2013 Audi, and a motorcycle, all in cash. Now, let's stop and talk about this cash thing, because we've talked about this before. When you have cash transactions, cash or cash equivalent is a cashier's check. A cashier's check is a representation that you have this cash in the bank and this check is representative of that cash. And when that person cashes their check, that check is good. Okay, that's why people prefer bank checks, because that bank check has already been paid for and represented by cash. So that's cash or cash equivalent. Now, in the United States, we have this law where if you have cash transactions, $10,000 or more in cash, those are required to be reported to the government. So the government is receiving notice that these same people are paying cash for 5 vehicles, a motorcycle, and oh, by the way, that $366,000 in cash. Now, that is typically not normal behavior. So that is going to raise some interest right there, because again, if you're dealing with law abiding businesses, these things are going to be reported. Okay. Now, this person, they were also convicted on one count of tax evasion in the state of Georgia for failing to report income on her state individual tax return. So if she didn't report it on the state, she didn't report it on the federal either. And one count of theft for improperly filing her client's state income tax returns. As a part of her sentence, included 15 years of probation and a $31,000 fine, and she's permanently barred from preparing taxes in the state of Georgia for any state, local, federal, or other than. She can only prepare her own taxes. She cannot prepare taxes for other people. Now, in that trial, she stated that her tax business earned $552,000 for the tax year 2012, and that $168,000 of these gross receipts were reported as profit on an amended 2012 state tax return, and then $150,000 from her hair salon. Okay, now when they filed their tax returns, though, they didn't report all of this income. So for her hair salon, she reported gross receipts of $20,316, and then for her tax business, she claimed $15,811. Both of those set, and then took some expenses. And so she reported, okay, and so then the IRS disregarded or disallowed the rent or lease expense of $18,000 from her hair salon, and they disallowed $5,000 in commissions from her tax business. And the reason why is that there were no records to substantiate these expenses. So what she reported, though, is she reported $980 in profit from her hair salon, and then $9,000 from her tax business as her net profit. Now, going back, it states that she made $552,000 from her tax business and $150,000 from her hair salon. Now, also keep in mind during this time that she paid $300,000 for a house and cash for vehicles. Okay, so this underreporting picture is already being developed here, because how are you going to report $980 in profit in one business, and what she do with the other one? $9,000 for another one, but yet you buying $366,000 in property, okay, and you paying in cash. All right, so since there were no records available, the IRS pretty much combed her bank accounts. She had 7 bank accounts, and it showed, based on their bank account analysis, that she received $1,054,255 in those accounts. There was an unexplained deposits of $911,000. That means they really don't know where that money came from. Okay. So anywho, after accounting for that, all of the income and the expenses, the IRS said that she should have had a gross receipts of $439,705. So now, let's talk about the expenses. So one of the things that the law says is that deductions are a function of administrative grace. That means that the government decides whether or not you can actually deduct these expenses. Now, we already know that anything that's ordinary and necessary for the running of your business is tax deductible, but you have to have the documentation, which means you need to have receipts. I don't care what y'all think about these bank statements, credit card statements, none of that. You got to have receipts, the actual receipts. When I say the actual receipts, I mean whether it's a physical receipt or a copy of receipt or something that details exactly what you bought, when you bought it, where you bought it from, and what you bought it for. That is what the receipt details. She didn't have none of that. Now, she told the court that she didn't have this substantiation because the state of Georgia still had it dealing with her case there. But they also state that she made absolutely no effort to get these records in order to satisfy the federal. Okay. Now, so when it's on you, the taxpayer, to provide that proof. The IRS can say, okay, we're disallowing it because we asked for the substantiation, we asked for the receipts, and she didn't give it to us. Well, if you come court, if you don't provide that documentation, then they're going to disallow the expense, and that's it. So, and it doesn't matter if it was a legitimate expense or not. If you don't have the receipts to show the substantiation, if you don't have that tangible evidence, it didn't happen. That's why I tell y'all to keep all your paper. I don't care if it's a nickel. Keep your receipts, because that is what is going to defend you and help you fight when something like this happens. Okay. Now, so then the other thing is for her filing status. Now, this is something that just absolutely I shouldn't be surprised, but I was. So her and her husband, they were married. They were living together the whole time. They weren't separated. But what they did is she claimed residence at one of the addresses that she bought, and he claimed a different residence when they were actually living together. Now, when they filed their taxes, they both claimed head of household, and they thought that because they listed these different addresses that they wasn't going to get busted. But she admitted in court that they were indeed living in the same house the whole time. Now, if you are going through a separation and your spouse doesn't live with you for at least 6 months out of the year, there is a clause that you can claim head of household. But if you are living together harmoniously or unharmoniously, whatever that looks like, if you're living at the same address, then your filing options, if you're married, are married filing joint and married filing separate. There is no head of household and single. There's none of that stuff. Okay. Now, with this person being a seasoned tax professional, it stated that she worked for a tax company before. She owned her own tax company. She put herself out there as this tax professional. She also said that she went to various conferences and stuff to keep up her skills. So she knew better than to be trying to file head of household. She knew better, but did it anyway. So now they got busted. So they ruled that no, you indeed were not eligible to file head of household. Now, if they then filed separately, that's where the question of earned income tax credit comes in, because you can be married filing joint and claim earned income tax credit, but you can't be married filing separate, which is essentially what they did, right? So they would not be entitled to the earned income tax credit. Okay. And because they underreported their income, at least it says she received a tax refund of $2,800 to which she really was not entitled. Okay. And so that's the thing about the due diligence. And this is why tax professionals are asking all of these questions, because the other thing that happened with this person is that she also got hit with a $45,000 due diligence fine, and for failing to do her due diligence. She had filed false returns for tax preparers, and so $500, 45,000 divided by $500, that's what, like 90-ish something returns that she filed incorrectly, and so she had to pay that $45,000 fine. And they be serious about them fines too. So then let me see what else is in here. We talked about the head of household filing status. And then we talked about the earned income tax credit. Now, the only bright side in this case for Ms. Degourville was that the IRS was seeking to bar her from claiming the earned income tax credit for 10 years. And then they said, well, if you can't get 10, can we do 2? But the IRS actually dropped the ball here and did not provide the necessary documentation to substantiate like the latest year that they falsely claimed the earned income tax credit. So then comes the fraud penalty. Now, the thing about fraud is that you have to really prove that it's fraud. Like this was something willfully done. Now, her name is Lakeisha Degourville. So what Lakeisha said is that, hey, I underreported income. Excuse me. I underreported income out of negligence. It wasn't fraud. And what she said is that she was running all of these businesses and she just couldn't keep up with everything. Right. But you spent $366,000 in cash buying a house. You spent another $90,000 buying the land. You spent all this cash to buy stuff, but you couldn't keep up with all of it. So that did not make sense at all. Ooh, all the things happening today. All right. So with the fraud, the IRS then has the burden of proof is then on the IRS to say, did she act fraudulently or was it negligence? And the thing about fraud is that there's what's called the badges of fraud. Now, one badge of fraud doesn't necessarily mean that you did something fraudulent. But when you have a whole series of things, that means you might be fraudulent. So her series of badges of fraud was that she understated income. She didn't maintain her records. She offered implausible or inconsistent explanations, concealing assets, failing to cooperate with tax authorities, and engaging in illegal activities, providing incomplete or misleading information to tax return preparer, offering false or incredible testimony, filing false documents, including filing false tax returns, or failing to file tax returns. These were all decided in Bradford v. Commissioner. So those are all the different badges of fraud. And so for Lakeisha, it says that the petitioner engaged in more than one illegal activity during the year in issue. She was assessed a return preparer EITC due diligence penalty for failing to comply with due diligence requirements when her clients trying to claim the earned income tax credit. And so that's where she totaled $45,000. And then she reported her income. She didn't keep records because she said she was just too busy to keep records. She did not provide a documentation when she was asked for it. So all of these things. Then she filed head of household when she knew she should not have filed head of household. So all of these things painted the picture that, yes, ma'am, you committed fraud. Now, with that fraud penalty, though, that's up to 75% of the tax due. So now her tax due was $139,000. Yeah, $139,000, and then she gets a civil fraud penalty of an additional $100,000. Now, keep in mind, she still has the Georgia state taxes to pay. She had the $45,000 tax preparer penalty, a due diligence penalty assessed against her. So, listen, this is a perfect storm of foolishness. Okay? Perfect storm of foolishness, because this person thought that they would be able to operate in cash and conceal their income. They underreported their income. They filed in statuses that they knew they were not eligible for. And this is why we as tax professionals have to be diligent. We have to ask for the documentation if something doesn't sound right. It's, because otherwise, I mean, she was just off the chain. I mean, $45,000, that's a lot. But I've seen fines up to $100,000 with these tax preparer penalties because people just out here doing stuff all willy-nilly. And the fact that she was a tax professional, she ran a tax business, she worked in a tax business, she obviously did some continuing education, going to conferences and stuff, so she knew better. And so she went to court, and essentially she's stuck with these penalties. Now, I was looked briefly. I do believe her husband wound up going to prison. I'm not sure if she has any prison time. I did not look. One of my other friends was looking, and she got a PPP loan for her business. I really hope she did not commit PPP loan fraud in addition to all of this stuff. So what are the lessons? One, keep your documentation. Keep your receipts. Whenever you buy something for your business, you need to, I don't care if it's the physical receipt, a scanned copy of the receipt, email the copy of the receipt, keep thy receipts. Okay. You need to have proper bookkeeping in place. Listen, a spreadsheet is a good place to start. Okay. But that's where you start, not where you stay. Okay. But either way, you got to track that income, got to track those expenses, and do not underreport your income. Oh my gosh, do not underreport your income. There are so many tax laws that allow you to save tax dollars. Underreporting income ain't it. Okay. It's just not. So I'm going to link this tax court case in the comments. So if you're a nerd like me and really want to read it, it will be there. But this is really a perfect storm case that is a lesson for tax professionals, and it is for consumers as well, to understand that, that documentation is so key. I don't care. Listen, I believe in paper trails. Like people talk about, I don't write checks. Listen, I want my paper trail, because in the event that I ever get audited, I want something that says, here it is right here. Here is this check, and here's where it was canceled or it was deposited or whatever, right? Because I want that paper trail. So yeah, that's it. Okay. So thank you so much for hanging with me on this. I know it was kind of a long one, but this is deep, y'all. This is really deep, but you can go and read the case. And so I'll be back. Thank you so much for sticking with me. Have a fantastic day, and I will see you all next time. Bye.